Any profit you make from selling an asset could be liable for capital gains tax, or CGT. This could be as much as 28%, so it's really important that you're aware of how CGT could affect you and factor it into your calculations when determining the quality of an investment. Now, capital gains tax may be applied to any profit when you sell or dispose of almost any asset that is worth in excess of £6,000. There are of course a few exemptions, such as when you sell your car or gift an asset to your spouse or civil partner, and there are also a number of tax-free vehicles you can hold assets in, such as ISAs, pensions and offshore bonds, where CGT just does not apply. So it's important to consider making use of these if you might be affected by capital gains tax. Basic rate taxpayers will have to pay 10% in capital gains tax for any gains that they realise, and higher rate taxpayers are required to pay 20%. So if you purchase shares in a general investment account for, say, £10,000 and sell them for £30,000, you'll have made a gain of £20,000. If you're a basic rate taxpayer, £2,000 will be levied in CGT, and £4,000 is going to apply for a higher rate taxpayer. But you do, very helpfully, have an annual capital gains tax allowance. Any individual can make up to £6,000 a year in realised gains completely free of tax. So if I take that example that I just ran through, the £20,000 gain could be reduced to £14,000, and so a basic rate taxpayer would only pay £1,400 in CGT, and a higher rate taxpayer would pay £2,800. Using your annual CGT allowance effectively can be a key component of sophisticated financial planning. If you have investments held within a taxable account, a high-quality financial planner will look to make disposals on an annual basis to make use of your annual allowance and continually reduce the gains within your portfolio. They'll typically subscribe the sale proceeds to an ISA or reinvest the money into a very similar investment fund before returning them to the original investments after 30 days have passed. As you're probably gathering, it's not a straightforward process, so it's best just to leave it to the professionals if you aren't very confident in how to do it. One asset where it is much harder to make use of your annual CGT allowance is property. Unfortunately, you can't really sell portions of a property in the same way you can an investment portfolio, so gains can really build up on buy-to-lets. Fortunately, CGT is not applied to your primary residence, but there is an additional 8% applied to any other properties you own, which of course means that 18% and 28% is levied for basic rate and high rate taxpayers respectively when they sell a second property. Pretty significant sum, and there's not a lot you can do about it, which can often make investing a far more attractive route to take. So, capital gains tax can have a really significant impact on your potential profits, and having a really clear understanding of how and when it's applied is key to effective planning. It's also really important to ensure you are active in managing it, particularly when considering your investments. It can be reasonably complex though, so as always, do take advice if it's an area that is significantly impacting you. Because remember, your money really does matter.